Good morning, everyone, and welcome. I call this meeting of the Ncaa Board to order. This morning, we are meeting to hold a public briefing on a revised budget for calendar year 2020 and a proposed budget for calendar year 2021. After opening statements by the board members, the 2020-2021 budget will be presented by Chief Financial Officer Rendell Jones. Following Mr. Jones's presentation, we're going to have a three-person panel of stakeholders offering their comments on the proposed budget. The panel would consist of three trade association representatives. Kurt Long, National Association of Federally Insured Credit Unions. Kurt, good morning, welcome. Mike Shank, Credit Union National Association. Good morning. And Lucy Ito, National Association of State Credit Union Supervisors. Good morning. Each member of the panel will have up to 15 minutes to present. I ask you all that you please respect the time limit. We have the written comments you've submitted, which are included as a part of the record. After the three presentations are done, there may be questions or comments from the board members. I want to thank all of the participants for being a part of this process. Now, as we begin, you all, it is indeed an honor and privilege to serve on the Ncaa board. I believe that consideration of the agency's budget is one of the most important responsibilities that we as the Ncaa board are charged by Congress to do. The budget sets forth not only how we plan to spend money on expenses related to the operations of Ncua, but also how we align resources in support of our important mission of safety and soundness. Today, we meet as the board for the purpose of hearing public input regarding the draft budget that Ncua staff has developed for consideration at the December board meeting. Ncua is responsible for overseeing the safety and soundness of our nation's credit union system and protecting the National Credit Union Share Insurance Fund. Our actions impact over 5,000 credit unions that serve over 118 million member owners. In discharging our duties, we as board members must remain mindful that the resources we spend come from the credit union system. Therefore, it is imperative that we must be good stewards. I know the budget for 2020-2021 was a challenging one for the Ncua staff to develop. In preparing the draft budget, staff had to weigh and balance the need to execute the Ncua mission and the mandates and cost drivers that impact agency finances against the need to be fiscally responsible and prudent. We have discussed these challenges, in particular, the sharp impact that mandated retirement system actuarial charges assessed by the U.S. Office of Personnel Management would have on the agency's budget in 2020. The schedule for this proceeding is that we will first receive a presentation on the budget from our Chief Financial Officer, Rendell Jones. Rendell will provide an overview of the staff's budget plan for 2020-2021, which will outline how Ncua plans to spend the funds collected under the staff's proposal. After we hear from Rendell, we will hear from a panel of public witnesses. Based on this input and what may be submitted in writing from other commenters, we will consider making further modifications before the final budget is adopted by the board in December. It is important to note that Ncua's commitment to stewardship does not end with the adoption of the budget, but continues with how we actually spend the funds we collect. I'd also like to point out that as of the second quarter of 2019, 44.5% of eligible Ncua contractual spending went to minority and women-owned businesses. I would also remind everyone that the Ncua publishes a very detailed description of its planned budget and other financial documents on our website. Transparency of the Ncua budget process, including the opportunity for direct public comment from stakeholders to the board that decides the budget, is unique for the Ncua among other financial regulators. As required by Congress, pursuant to the Federal Credit Union Act, final decisions on the Ncua budget are vested with the board. We take all public comment seriously and under advisement before making a final decision. Before I invite Rendell to make his presentation, I'd now like to invite my colleagues on the Ncaa board to offer any opening comments they may have. Board Member Harper.
Thank you, Mr. Chairman. I appreciated your very thoughtful remarks and fully agree with you that the budget is one of the board's most important responsibilities. While I have yet to decide how I will vote on the proposed budget, I will be looking closely at the issues of shrinking budget ratios in the month ahead. While we can always achieve further operational and staffing efficiencies, I have apprehensions about whether we can be a prudent steward for the credit union system if we cut too deep. One measure of budget efficiency is the dollars of agency budget compared to the total industry assets. At the start of this century, we saw a steady decline in this figure, which bottomed out in 2008 at $210 per $1 million of insured credit union assets. Those efforts cut into the bone and left the agency flat-footed and ill-prepared for the financial crisis. To play catch-up and address this situation, the agency's budget spiked in the following 3 years, with annual increases exceeding 10% at a time when credit union balance sheets remained quite stressed. In my view, it's better to maintain steady, manageable increases over time. In that regard, I am concerned to see that the 2020 budget would spend just $206 per $1 million of insured credit union assets. In considering the comments today and investigating the proposed budget further, I will be working to understand whether this level of funding is sufficient for the agency to meet not only its safety and soundness mandate, but also its consumer financial protection responsibilities. Accordingly, I'm looking forward to engaging with today's witnesses about how we can best ensure that credit union members' interests are best protected in today's complex financial marketplace.
Great, thank you. Board Member McWaters.
Thank you, Mr. Chair. I have no official opening statement except to note that in the budgetary process, this agency is funded with other people's money from the credit union community. It's not the chair's money or board member Hood's money. It's the credit union community's money. We should remain respectful of that, mindful of that. At the same time, we have a statutory mandate of safety and soundness for the Share Insurance Fund, for the credit union community itself, for consumer protection and the like. And all three of us, I believe, take that obligation very seriously. So we balance the fact that we're using your money, the community's money, but we have a job to do and we will do it. I think we balance it by starting with these budget briefings and budget hearings. It was something that I championed 5 years ago and called for it. When Chair Metzger took the gavel, he started the budget hearing process, and I continued it, and we're doing it today. It's the right thing to do because, again, we're using funds from credit unions themselves. Also, 5 years ago, I was concerned about the transparency of the budget. It was very thin. There wasn't much to it. Today, Mr. Jones and his excellent staff have produced a 107-page document. At least that's the latest copy I saw. I thought I would just wait for the movie instead of reading it, but Rendell promised that Brad Pitt was not available to play him, and so he was going to hold off on that. So it's incredibly detailed. There's a lot of information in it. It's what the credit union community asked for. It's what the credit union community deserves. So Mr. Jones produced it, and I thank him for that. With respect to the safety and soundness issue, again, it's a balance, and I certainly appreciate the comments made by Board Member Harper that we cannot cut this thing to the bone. In fact, in my very first budget, back in 2014, I included this sentence in my written statement. If the Ncua truly needs to retain the services of additional professional staff so as to discharge its mandate in a competent manner, the agency should do so without needless hand-wringing. That applies today. At the same time, we should not be profligates because we're using other people's money and need to remain mindful of that. So I look forward to this, look forward to hearing from our witnesses, and so thank you very much.
Thank you. I will now ask Chief Financial Officer Rendell Jones to present the proposed budget. Rendell, the floor is yours.
Good morning. My name is Rendell Jones, and I'm the Chief Financial Officer of the National Credit Union Administration. I'm here to present an overview of the draft Ncua 2020 and 2021 budget. I, too, would like to thank stakeholders and members of the public for coming here today and watching online and showing their interest in the proposed budget for 2020 and 2021. The draft budget was posted to our website on October 29th and also published in the Federal Register on November 1st. On slide 2, the agenda outlines the items I plan to cover in today's briefing. First, I will review some of Ncua's key accomplishments over the past year. Second, I'll discuss the strategic context and goals that are the foundation for the budget. Third, I'll review historic budget trends. Fourth, I will summarize the proposed operating budget, capital budget, and share insurance fund administrative budget. And finally, I will review how Ncua finances its budget. In the next few slides, I would like to highlight some of the noteworthy results of the past year. So on slide 3, you can see Ncua's regulatory work, and the agency has issued a proposed risk-based capital rule. This rule proposes delaying implementation of the risk-based capital rule until January 2022. A final real estate appraisal rule that provides clarity and regulatory relief for required appraisals in certain commercial real estate transactions. A final rule that creates more alternatives for borrowers by allowing federal credit unions the option to offer more payday alternative loan options. And a final rule that will raise non-member share limit to 50% and eliminate the waiver request process. Slide 4 discusses several other recent initiatives. The Second Chance Initiative, which would streamline the ability of credit unions to make their own hiring decisions in certain specific cases. Recent guidance letters clarifying the Ncua's policies and oversight responsibilities for secondary capital plans and certain financial services to legally operating hemp businesses, and the appointment of a new special advisor to the chairman for cybersecurity who will help lead Ncua's efforts to assist credit unions address a growing risk area. And finally, on slide 5, other recent efforts include Ncua recently initiated new cooperative agreements with the Small Business Administration and the National Association of State Credit Union Supervisors. The board continues to do outreach to credit unions through speeches and other engagements. And earlier this year, as directed by the Ncua board, my office distributed over $160 million in share insurance fund dividends to more than 5,500 eligible institutions. Slide 6 shows how the board-approved strategic plan is the foundation for the draft budget and how budgetary resources support the Ncua's strategic goals. Goal 1, ensure a safe and sound credit union system. The budget proposes funding for several important initiatives focused on the safety and soundness of the credit union system. Analysis of market risks, new programs, and evaluating cybersecurity threats, and nationwide training supporting our new examination tool, Merit. Goal 2 provides a regulatory framework that is transparent, efficient, and improves consumer access. And so the budget proposes funding for ongoing regulatory reviews and development, as well as efforts to assist chartering new credit unions and assist existing credit unions expanding their operations. And Goal 3, maximize organizational performance to enable mission success. The budget proposes investments in a range of technological improvements, facilities maintenance, and human capital planning, all of which will contribute to the long-term operational efficiency of the agency. As discussed in the budget justification, slide 7 shows external developments that affect the credit union system and that influence how Ncua manages its resources and adapts to changes. High visibility factors include the emergence of cybersecurity risks and opportunities, emerging concentrations in credit union lending, the evolution of growth in financial technology products as competitors to more traditional credit union products, demographic shifts that influence credit union services, and consolidation trends. And the Ncua has implemented an enterprise risk management program that keeps the agency's leadership informed of how Ncua programs and operations respond to such a changing environment. And the 2020 budget includes several investments that are the result of enterprise risk management reviews, which are listed on slide 7. Slide 8 compares the relative size of Ncua's budget to the federal banking regulators' budgets, expressed as a share of total system assets. The calculation divides the budget in millions of dollars by the prior year credit union system and banking system end-of-year assets, respectively. It is notable that Ncua's budget as a share of federally insured credit union assets is decreasing and remains below the equivalent rate of the federal banking system. These trends do demonstrate Ncua's continued operational efficiency compared to both the size of the credit union system and to the operations of the federal banking regulators and insurer. The graph on slide 9 illustrates Ncua's budget adjusted for inflation. On an inflation-adjusted basis, the 2020 operating budget increases by approximately 1.7% compared to the 2019 board-approved budget. Slide 10 shows the nominal annual growth rate of the Ncua operating budget year by year since 2001. In nominal dollars, the 2020 operating budget grows 3.9% or $11.8 million compared to the 2019 board-approved level. Within this total, approximately $5 million of the annual increase, or 1.6 percentage points of growth, results from increased charges assessed by the United States Office of Personnel Management for the federal employee retirement system. I'll discuss these costs in more detail later in my presentation. Slide 7 displays the total operating budget of $316.2 million in a pie chart and our standard budget categories to highlight how the resources are allocated. Personnel and travel costs remain the largest spending components, comprising over 80% of the budget. The other budget categories include contracted services, which make up 13.7% of the budget, rent, communication, and utilities, which comprises about 2.6% of the budget, and administrative expenses, which make up a little less than 2%. There's an overall increase of 3 full-time equivalent positions compared to the current authorized 2019 level. Slide 12 presents a side-by-side comparison of the major budget category estimates and the prior year board-approved levels. This slide shows the total 3.9% nominal increase in the operating budget. As I mentioned earlier, and we'll discuss in more details in the next slide, excluding approximately the $5 million increase in mandatory payments for the federal employee retirement system, the operating budget grows by approximately 2.3% in 2020, as shown in the bottom row of this table. Slide 13 shows the proposed 2020 budget for total personnel costs, which is about $231.4 million. This includes all Ncua employee salaries and associated benefits such as health insurance and retirement costs. Annually, my staff reestimates the Ncua's compensation costs based on actual year-to-date spending and adjusting for workload hour utilization and projected hiring. The proposed budget also reflects an adjustment for an expected about 2.2% vacancy rate during the year. The collective bargaining agreement sets the parameters for pay adjustments to comply with the Federal Credit Union Act. And this stipulates that Ncua's compensation should, quote, maintain comparability with other federal bank regulatory agencies, end quote. Overall, the budget for employee salaries increases by approximately 1.8% in the draft budget proposal. The largest share of growth in the pay and benefits categories comes from the revised assumptions by the United States Office of Personnel Management for actuarial valuation of the federal employee retirement system, or FERS. Charges for employees' FERS participation have increased significantly for 2020. All federal agencies are now expected to contribute a higher amount to the system. Slide 14 shows the proposed increase of 3 positions compared to 2019, resulting in a new personnel level of 1,185 for the entire agency. As indicated on the chart, total Ncua staffing has remained within a relatively narrow band since last year, after having been reduced by approximately 80 positions between 2015 and 2018. Moving on to travel. The proposed travel budget for 2020 is $27.4 million, an increase of roughly $600,000 compared to the 2019 budget level. Included within the draft travel budget for 2020 is sufficient funding for travel-related costs of training all Ncua examiners and other relevant personnel on the new merit examination system. This is an in-person training, and students will receive 1 week of instruction on the new examination tool. And the increase is offset by other reductions in regional office travel budgets, largely resulting from the expanded use of off-site examination procedures. Slide 16 shows the proposed budget for rent, communication, and utilities in the amount of $8.2 million, which is 2.3% more than the 2019 level. Rent, communication, and utilities makes up approximately 3% of the total Ncua budget. And this budget includes costs for telephones and other telecommunication systems, office utilities, and postage, regional office building leases, and meeting rental expenses. Administrative services. The budget for administrative services appears to decrease substantially in 2020 as shown on this slide. However, the reduction does not just reflect lower anticipated spending, but is actually a result of reclassifying the cost of various service contracts, maintenance fees, and end-user licensing of computer software and database management applications to the contracted services budget. Approximately $2.6 million of funding for these purposes was realigned in order to present Ncua's budget in a manner more consistent with other government agencies. Slide 18 provides an overview of the draft budget for contracted services, which totals $43.3 million in 2020. As I explained on the previous slide, a total of $2.6 million in information technology costs were reclassified from the administrative expenses budget to contracted services in 2020. Therefore, the net increase in contracted services budget in 2020 is approximately $2.7 million. Contracted services makes up approximately 14% of the 2020 budget and consists of a variety of recurring activities and projects acquired from the commercial marketplace. The Ncua contracted services budget pays for information technology operations and maintenance, IT security, professional training, accounting, procurement, payroll, and human resources systems and services, building operations, maintenance and security, and administrative or other general services. Changing the contracted services budget for 2020 results from new efforts to address priority areas like cybersecurity within the credit union system, operations and maintenance costs associated with capital and prior capital investments, and other inflationary increases. Increased funding for information technology categories of contracted services budget will pay for implementation of recently acquired network security tools and operational support for prior capital investments. Growth in the building maintenance and operations category funds a new access control and monitoring system for Ncua's facilities, and an increase to the administrative and other support category will be spent on initiatives to strengthen credit union cybersecurity. Slide 9 presents a pie chart that breaks out the contracted services budget into 7 categories. Information technology operations and maintenance is the largest component, comprising about 45% of the total contracted services budget. Other major contracted services categories includes administrative support and other services, and that's about 14% of the contracted services budget. The contractual obligations for Ncua's accounting, procurement, payroll, and human resources systems, which makes up about 10% of this budget, and operations and maintenance support for Ncua facilities, which makes up another 10%. The remaining categories each comprise less than 10% of the total contracted services budget as shown in the pie chart. I'd like to note that the IT operations and maintenance category is expected to be a growing share of the contracted services budget as new capital projects continue to be implemented and become operational. Investments in new technology will deliver systems with more advanced functionality and improved security controls. These more complex systems are also generally more expensive to operate than legacy systems, some of which are 20 years old. Slide 20 provides additional descriptions for the 7 categories I just described in the pie chart in descending order of the percentage. As requested in prior public comments, more detailed information about Ncua's contracted services budget is found on pages 44 to 47 of the draft budget justification document. Next, turning to Ncua's capital budget, Ncua uses a rigorous process to identify investments for information technology, facility improvement and repairs, and other multi-year capital investments. The capital budget includes funds for software development projects, hardware replacement and upgrades, and other information technology system costs, such as security upgrades to defend against cyber threats. The largest capital budget project is for the development and implementation of Merit, which is the replacement for the Ares examination system. Facility improvement and repairs will support the central office building and the southern region building. A major project plan for 2020 in the central office is the replacement of the heating, ventilation, air conditioning system, which is a priority since the system is original to the building and well past its useful life, having been implemented in about 1993. Slide 22 is a summary of the major capital budget categories and presents them just in a tabular format. For example, you will note that funding for information technology software development has increased by 21.6% over 2019, and other information technology investments have decreased by 30%. And finally, capital budget improvements and repairs have increased by approximately $600,000. Slide 23 includes a list of all of the individual budgets that make up the draft 2020 capital budget. Additional descriptions of each project, along with associated project milestones and performance measures, is in the written budget justification document. As I noted with contracted services, the detailed descriptions in the budget justification were added in response to prior public comment and include more information for stakeholders to get a sense of the agency's planned initiatives. Beginning on slide 24, the next 3 slides highlight the Share Insurance Fund administrative budget, the final budget discussed in today's public briefing. This budget pays for the direct cost of the Share Insurance Fund administration and management, including support for the Ncua Guaranteed Notes program. Slide 25 shows the proposed 2020 budget for the Share Insurance Fund administrative expenses, which is about $6.5 million and also supports 5 staff positions. The draft 2020 budget is $1.9 million less than the 2019 approved funding level, largely due to the planned phase out of third-party supervisory stress testing for large credit unions and a decrease in costs for the valuation services contracts that support the NGN program. The major budget components for the Share Insurance Fund administrative budget are highlighted in the pie chart. NGN program costs account for 42% of this budget, while the Share Insurance Fund direct expenses represent about 34% of the budget. Employee pay, benefits, and travel are about 25% of this budget. Slide 26 shows the Share Insurance Fund administrative budget by major category compared to the 2019 approved levels. As I previously explained, the budget decreases in 2 areas in 2020. Third-party supervisory stress testing for large credit unions, which is a Share Insurance Fund direct expense, and contractual support for valuing the NGN portfolio. Slide 27 summarizes the financing sources for Ncua's budget. In addition, pages 57 through 63 of the draft 2020 budget justification, published on the website and in the Federal Register, explain the Ncua's board-approved methodology for determining the operating fee. The average operating fee is estimated to increase by 1.2% in 2020, and the justification document includes more detailed discussion and tables showing how this change is calculated. The budget justification also includes a draft fee scale and schedule using an estimated overhead transfer rate of 61.3% and an estimated credit union asset growth for the year of 5.6%. The OTR estimate included in the staff draft budget is calculated using the board-approved overhead transfer rate methodology, and the methodology remains unchanged as reflected in this draft document. The table and pie chart on this slide illustrate the proportions of Ncua's budget paid by federal credit unions and federally insured state chartered credit unions. In percentage terms, federal credit unions cover about 70%, while state chartered credit unions pay for about 30%. All of the draft 2020 budget information is posted on Ncua's website at the link shown in this slide, which adds to the extensive documentation available to the public that explains how Ncua spent its resources to ensure credit union system safety and soundness. I'll conclude my presentation by reiterating a few key points. The three draft budgets for 2020 include a 2020 operating budget of $316.2 million and 1,180 full-time equivalents, 2020 capital budget of $25.1 million, and a 2020 share insurance fund administrative budget of $6.5 million and 5 FTE. The budget reflects our commitment to efficiency while ensuring we have the resources necessary to accomplish our mission to provide for a safe and sound credit union system. On slide 29, I've included my contact information for any members of the public who have questions or want to contact my office about materials I've presented today. Finally, slide 30 provides a link to a copy of the draft budget justification that was printed in the Federal Register on November 1st. For those who are not at today's briefing but would like to submit written comments on the draft budget, they can email their views and comments to budgetcomments@ncua.gov, and the deadline for submission of those comments is Monday, December 2nd. The presentation also includes a short appendix of materials that I don't plan to review in this briefing. The appendix has a bit more detailed information about Ncua's funds and where to find Ncua's section of the President's annual budget proposal to Congress. Thank you for your time today, and that concludes my presentation, Chairman.
Great. Thank you, Rendell, for your informative presentation on the Ncua budget proposal. I especially want to thank our Ncua staff who all played a role in helping to draft the budget proposal. I do have a few quick questions or points for clarification. I understand that Ncua is at the forefront of financial transparency with this particular budget. Rendell, can you please describe for me what our peer regulators do in this regard and what are our efforts to be transparent?
Sure, we are much more transparent than our other peers. The other federal regulators have very little information on their website. One of them I looked at this morning, maybe about a 10-page memo and a couple of charts. But none of them also do a public briefing. And so our website has an extensive amount of information, including line item detail for every single office for Ncua, so a lot of detail.
Great, thank you. And I do have another question, and that is the proposal shows an operating budget increase of 3.9%, and you mentioned that the required retirement contributions are a big driver of that. Can you, again, go into a little bit more detail as to why, and also, is this a change from prior years? I believe it may have been slide 10.
It is a change from prior years. So the U.S. Office of Personnel Management runs the federal employee retirement system, and nearly all federal agencies are required to participate in that system. And so they sent out a letter to all federal agencies increasing the rates charged by about 230 basis points. So previously we were contributing about 13.7% of employee pay to the retirement system, and that increased to 16%. So it's about a $5 million change in required costs leveled on us by another federal agency, and that comprises about 1.6% of the budget growth.
Great, thank you. So that was required. So that we already started the budget knowing that that had to be accounted for.
Correct.
Very well. Well, thank you. Do you have any questions, Board Member Harper?
Rendell, thank you for your presentation. I very much appreciated it. I do have just one question. When I was previously with the agency, we often spoke about zero-based budgeting, where each year, as we went through the budget process, we began and looked at the budget anew and justified each cost in the budget. I didn't hear you mention that today. Was that an omission, or has there been a change in how we go about developing the budget?
There's generally not a change since you were previously here. So we do continue to look at all costs at a detailed level. And so in zero base, for example, there's an analysis credit union by credit union of anticipated exam hours based on the specific condition of that credit union. That happens every year, and all of those, for example, are accumulated to determine what the requisite level of staffing is needed for examiners. And on the non-personnel side, we did do a very detailed look, as we have in the past, to whether or not expenses are really required and if there are alternatives to meeting whatever those objectives are. So yes,
Thank you.
we have done that.
Okay, thank you. Board Member McWaters.
Thank you, Mr. Chairman. The only question I have, Rendell, more of an observation, is that I look on slide 8 and I notice that in 2020 we're projecting the credit union community total assets to equal around $1.5 trillion. That's the green line. And if you go back to 2010, it was $880 million system-wide total assets. And if my math is correct, that's around a 74% increase in the size of the credit union community system industry, however you want to refer to it. If you look at the dark blue line, looks a little black on the screen, it shows that the Ncua back in 2010 was spending about $227 for each $1 million of credit union community assets. And in 2020, we're projected to spend around $206 per $1 million of credit union community assets. And that's a decrease of slightly over, I think, 9%. So due to the efficiencies of scale of a growing credit union community, which has grown 74%, our budget relative to asset size has dropped about 9%, which is a point that is often missed by some. Also, I think it's important to note that if you look at 2019, the yellow line shows the FDIC operating budget, OCC, and the Fed, but $245 per $1 million of bank system assets. It's higher than that spent by the Ncua because banks generally, particularly the large banks, JP Morgan Chase, Wells, Citi, B of A, and the like, are quite a bit more complex. And plus, I think there's some inefficiency when you have 3 separate and distinct regulators operating. There's some overlap there, which increases their amount up to the 245. Yet I will note that it is materially less than the $209 amount on the bottom line chart for 2019 of the Ncua. That's all I have. Thank you.
Great, thank you. I now would like to ask Mr. Long, Mr. Shank, and Ms. Ito to come forward. Again, you are welcome and good morning once again. You'll be going from my left to right, starting with you, Mr. Long. And again, as a reminder, you will have up to 15 minutes to present. Comments and questions will be held until the end. And once again, welcome. We're delighted you can join us.
Thank you.
Mr. Long.
Good morning, Chairman Hood and board members Harper and McWaters. My name is Kurt Long, and I am the Chief Economist and Vice President of Research at the National Association of Federally Insured Credit Unions. I first want to thank the Ncua Board for its strong leadership and continued commitment to helping to improve the lives of over 118 million consumers by ensuring a safe and sound credit union system. The strong Ncua is one of NAFCU's key priorities. NAFCU supports the Ncua Board's efforts to promote transparency and accountability so that credit unions understand just how their dollars are being put to use. NAFCU encourages the Ncua to continue to be the leader among other financial services regulators by publishing a detailed draft budget and soliciting candid feedback from the industry to improve the efficient use of its sizable budget. Each year, the Ncua constructs a budget to execute the agency's mission, goals, and strategic objectives. In late October, the Ncua released its 2020 and 2021 proposed budget justification. NAFCU commends the Ncua on its continued attention to eliminating duplicative spending and finding methods to promote efficiency in its day-to-day operations and implementing its longer-term projects. However, Ncua's budget is still increasing year over year. NAFCU is not suggesting that the agency indiscriminately slash its budget, but is yet again encouraging an ongoing agency-wide commitment to manage its funds in a prudent and transparent way. Below, NAFCU outlines several recommendations to improve accountability, including 1, conducting robust cost-benefit analysis and lookbacks for Ncua programs, not just rules. 2, providing additional information on the Ncua's exam modernization programs. 3, providing more information on the expiration of the Ncua Guaranteed Notes, or NGN program, and potential future dividends or payments to credit unions. And 4, assessing risk in the system and whether safety and soundness is appropriately balanced with prudent regulation. In this third year of implementing the agency's strategic goals outlined in the 2018 through 2022 strategic plan, the proposed budget justification provides some detail on the development of those priorities, most important to the credit union industry. Part of pursuing the agency's core values, namely integrity, accountability, transparency, inclusion, and proficiency, should include providing credit unions with detailed information to understand how their valuable dollars are being used. To more clearly demonstrate the agency's commitment to the prudent management of its funds, NAFCU urges the Ncua to consistently engage in cost-benefit analysis as it looks at existing and future programs. The agency should also provide the industry with an opportunity to comment on its methodology through the standard rulemaking process. This could be part of or in conjunction with the agency's statutorily required Federal Register notice for comment on its budget materials. The 2020 proposed operating fund budget is $316.2 million, which represents a real dollar increase of $5.2 million or 1.7% from the 2019 board-approved budget. This also represents a 57% increase in only a decade, while the credit union industry is on pace to consolidate by 32% over that time frame. The credit union industry remains focused on the efficient use of resources and encourages the Ncua to do so as well by achieving year-over-year budget reductions. The cost-benefit analysis for every portion of the Ncua's budget, combined with regular lookbacks for the Ncua's programs, could bring the agency closer to achieving such efficiencies. This would also align with the administration's directive to reduce burdens and eliminate duplicity in existing and new regulations. The agency has indicated it would voluntarily follow the spirit of Executive Order 13771, and this is another method through which the agency can alleviate burdens and potentially reduce the size of its budget. Although the agency continues to point to a decline in the relative size of the Ncua budget compared to credit union balance sheets, asset growth alone does not mean the industry is more complex or that the budget is more efficient. As has been said in the past, the Ncua examines and supervises credit unions, not assets. Although the size of a credit union is a useful measure of its importance to the system, size alone does not determine complexity or riskiness. In 2018, the Ncua developed the Revised Complexity Index, or RCI, which was based on a menu of assets and liabilities that the agency considered to be complex. The total number of complex activities across the industry peaked in 2015 and has since declined. Furthermore, the number of credit unions engaging in 3 or more such activities follows the same pattern, having declined by over 140 since 2015. Despite this decrease in complex activities, the Ncua's operating budget has continued to expand over that same time frame without clear explanation or comprehensive rationale in the form of a cost-benefit analysis. The Ncua should moderate its supervision based on objective indicators similar to the RCI, as opposed to abstract and tangible risks that may not be consistent across the industry. NAFCU recommends the agency focus on holistically improving a couple key supervisory elements and evaluating ways to find economies of scale and other efficiencies in the continued operation of its various programs, as well as the implementation of new ones. These supervisory improvements include exam modernization and cybersecurity enhancements. Considering credit unions continue to struggle with procedural inconsistencies and other exam-related issues, the Ncua should prioritize its exam modernization initiatives, including the Flex Pilot Program or offsite exam for offsite exam procedures, and the Virtual Examination Program to standardize exams and relieve burdens. NAFCU is also pleased to see significant advancements in the implementation of the Enterprise Solution Modernization Program, which includes the replacement of areas with the new merit system. Successful deployment of this new platform could provide cost savings for both credit unions and examiners. Merit could also provide substantial efficiencies and help to facilitate more virtual exams. Although it was originally estimated to cost $20.8 million through 2019, the agency now estimates that through the remainder of 2019 and in the budget for 2020, total costs for merit implementation will reach $36.6 million. This considerable increase over the course of the 2-year rollout of the new program is alarming. With any program, especially one of this magnitude, NAFCU urges the NCUA to conduct robust cost-benefit analysis as to its projected efficacy. NAFCU and its member credit unions support the implementation of new technologies and systems, as well as the accompanying required staff training. However, credit unions are left asking themselves, at what cost? Is the NCUA likely to achieve the intended results of its latest new project with larger and larger budgets each time? NAFCU generally supports the NCUA's commitment to modernizing its exam process and hopes to see the agency leverage advancements in technology to reduce the length of exams, improve consistency, and reduce the overall burden on credit unions. However, the agency has not shared much about the progress of several of its exam initiatives. The agency could also better inform regulated institutions with a report and more detailed information on the cost savings associated with extended exams for well-run, low-risk credit unions above $1 billion. According to a recent survey of NAFCU members, the length between their most recent 2 exams was unchanged from the 2018 survey results. Fewer than half of our respondents with less than $1 billion in assets reported an exam cycle of 18 months or greater. In 2017, the NCUA announced that it expected to fully implement extended exam cycles by this year. Yet the evidence from NAFCU's survey indicates that much work has yet to be done. Furthermore, the average number of on-site examiners and the average length of exams grew slightly in this year's survey as compared to a year ago. Survey respondents from credit unions with under $100 million in assets were the most likely group to report that the time allocated to exams had increased significantly. NAFCU has long said that expanding eligibility for extended exams could substantially reduce the agency's operating budget. With more information about the progress of the initiative, the industry could provide more useful feedback that would help to conserve valuable resources for the entire industry. Additionally, the agency could provide more periodic updates on the research and discovery phase for virtualizing elements of the exam process. Virtual exams have the potential to enhance consistency by implementing standardized protocols for examiners and improve the overall quality of the exam process for all parties. Over half of the respondents to our survey said they were concerned about exam consistency, and 43% said that their highest priority for exam reform was more consistent application of rules and guidance. At the same time, 59% of our respondents said that access to exam-specific guidance was somewhat challenging, a factor that could potentially worsen misunderstandings or differences of opinion with individual examiners. Although it appears that the NCUA has overall been headed in a positive direction with its exam modernization initiative, the opaque nature of its actions has left many credit unions asking questions. It is critical that the NCUA delineate what success looks like for the agency so that credit unions understand expectations and their responsibilities. If credit unions have input into the agency's initiatives, they can better inform the process and hold the agency accountable for reducing exam burden. The industry would greatly benefit from a feedback mechanism akin to the FDIC's post-examination survey, which applies to all FDIC-supervised institutions. The NCUA should institute a similar survey, the results of which would be sent to the NCUA's ombudsman, to allow for candid feedback on issues like exam fairness, consistency, and overall burden. This could help to improve accountability and promote transparency within the agency's exam function. Considering that the liabilities associated with the NGN program are set to expire in 2021, the NCUA should promptly provide the industry another update on the legacy asset disposition strategies under consideration and how the NCUA plans to choose among the alternatives. In the interest of accountability, the NCUA should clearly outline the pros and cons of each alternative under consideration, as well as the implications for depleted capital holders and the Share Insurance Fund. NAFCU has heard numerous anecdotes of credit unions being approached by third parties seeking to purchase those capital certificates at steep discounts. A briefing or FAQ on this topic would help to clarify the nature of those claims to credit unions. As a regulator, the Ncua is both responsible for monitoring the safety and soundness of the credit union system and for creating a functional framework of rules for credit unions to operate. Post-financial crisis, credit unions were subject to regulation that impeded their growth, and NAFCU has worked with the agency and other regulators to lessen that burden. However, in recent years, while the pace of rulemaking has slowed, the burden on the exam side has increased. Although reducing regulation has improved flexibility, NAFCU's member credit unions have found that consistency and certainty have also decreased. NAFCU urges the Ncua to closely evaluate its exam processes and procedures to understand whether it has been substituting exam findings and changes in the exam process for notice and comment rulemaking. NAFCU's members continue to provide examples where examiners have used certain unofficial policy guidance as de facto regulation to hold credit unions responsible for certain behaviors and activities that are not clearly prohibited by law. This, coupled with ongoing feedback regarding inconsistencies in the exam process, raises questions as to the extent to which the agency is circumventing rulemaking through the implementation of tougher experimental exams. NAFCU understands that there is a balance between the agency's dual roles, but questions whether the Ncua is taking an overly risk-averse approach to its management of the industry. NAFCU believes that both flexibility and certainty can and should coexist in this instance and other areas. One such area is cybersecurity enhancements for both the agency's systems as well as the industry at large. NAFCU's member credit unions continue to identify cybersecurity as a top concern for their institution. As such, NAFCU appreciates and supports Chairman Hood's focus on cybersecurity as the financial services industry is becoming increasingly digitized and hackers are becoming more sophisticated. NAFCU also appreciates the recent board briefing during the October board meeting where agency staff provided updates on the agency's new cybersecurity-related activities. The Ncua board has made it a priority to outline 4 new cybersecurity goals. NAFCU generally supports these principles as well as investments into a strong cybersecurity framework. However, cautions the agency against devoting too many resources without a formal assessment process for its work in this area. NAFCU urges the Ncua to examine whether such investments are serving their intended purpose using robust cost-benefit analysis. Aside from allocating $500,000 to acquire and implement data loss prevention tools and processes, the budget hardly itemizes any cybersecurity-related expenses for 2020 and 2021. NAFCU is concerned that some of the agency's proposed investments into cybersecurity improvements, although well-intentioned, may be decoupled from results-based metrics and may continue to drive costs disproportionately, resulting in yearly budget increases. Furthermore, NAFCU requests the agency find more opportunities to leverage existing cybersecurity expertise from other regulators through the FFIEC in order to reduce expenses and eliminate overlap. NAFCU recognizes and appreciates the Ncua's development of a new tailored exam program modeled on the Intrex solution used by the FDIC, the Federal Reserve Board, and state regulators. This program is another opportunity to improve consistency and establish measurable expectations for exams. Considering that only 1/4 of respondents to NAFCU's recent member survey indicated that their last 3 cybersecurity exams were very consistent, NAFCU appreciates all potential avenues for improvement of this aspect of the exam process. NAFCU and its member credit unions also ask that the Ncua continue to consider ways to reduce expenses related to contracted services. For the second year in a row, contracted services has seen one of the largest percentage increases as a portion of the 2020 budget, totaling a 13.8% increase from 2019. In 2021, the agency projects a 9.3% increase in contracted service expenses due to systems operations and maintenance support for merit. NAFCU acknowledges the necessity of contracted services in certain instances and fully supports the use of experts to, for example, more quickly complete and propose a rulemaking for subordinated debt. Nonetheless, contracted services comprise a considerable portion of the Ncua's operating budget, and it would behoove the agency to find cost-effective means of training existing staff to conduct certain activities and minimize reliance on contracted services. In conclusion, today's briefing marks another year of the agency's commitment to improving budget transparency and stakeholder engagement. Although NAFCU has made several recommendations for ways to improve the agency's accountability in the budget process, the opportunity to provide recommendations in a public forum is incredibly valuable and essential to ensuring a strong, growing credit union system. NAFCU applauds Chairman Hood and board members Harper and McWaters, as well as the dedicated NCUA staff, for the many hours spent preparing the budget justification and other budget materials for today's hearing. More importantly, we value the day-to-day commitment to the stewardship of credit union member funds. Thank you for the opportunity to appear before you today.
Thank you, Mr. Long. Mr. Shank.
Good morning.
Good morning.
I'm Credit Union National Association Chief Economist Mike Shank, and I appreciate the opportunity to share some of the observations that we have on NCUA's budget process, the budget itself, and on the agency's strategic direction implicit in the proposed budget. Believe it or not, I joined CUNA way back in the 1900s. And one of the first tasks that I was given was to take a look at the NCUA budget. And it was a really difficult task. It was almost impossible to find any of the information that I needed. And so Rendell's comments really do, I think, ring true. It is certainly true that even within the last several years, there's been more information provided. It's better organized, easier to understand, and there's a better connection to the strategic plan. So we applaud you for all of that work. It's also true that in general, NCUA has never been more transparent in communicating this information, and so we appreciate that as well. NCUA has listened to CUNA's concerns and to the concerns of our member credit unions, and especially so over the course of the last several years. For example, several years ago, CUNA expressed concern about the NCUA's overhead transfer rate calculation, and in November of 2017, the board approved adjustments that demystified the OTR calculation process, resulting in a fair, simplified, and principles-based methodology. CUNA also objected to fast-rising costs and overstaffing, and we urged the NCUA to more aggressively look for efficiencies. You responded. In January of this year, NCUA consolidated its 5 regional offices into 3. The NCUA reorganized and streamlined the Office of Small Credit Union Initiatives, and in addition, the NCUA is now well on its way to using an extended examination cycle for many well-managed, low-risk federal credit unions, and it performs streamlined examinations for well-managed small credit unions. We applaud those actions. CUNA has examined the budget justification document and once again find it to be clear, comprehensive, and well-developed. The proposed activities and expenditures described align with previously announced and discussed strategic initiatives, including the Exam Flexibility Initiative, the Examination and Data Analytics Initiative, as well as modernization of the agency's information technology systems and cybersecurity concerns. The NCUA's proposed 2021 budget reflects a 3.9% increase, which seems reasonable in the context of approximately 2% inflation and against the backdrop of 6% increase in credit union operating expenses overall. CUNA fully understands and appreciates how personnel costs have a dramatic effect, as Rendell described, have a dramatic effect on the overall agency expenses, and we recognize that regulatory and contractual obligations drive a substantial portion of the changes in overall agency expenses. We look forward to seeing more obvious evidence of cost savings and remote and extended examinations and how those might have an effect on not just expenditures overall, but the headcount. We really appreciate the fact that the headcount has stayed fairly stable over the course of the last several years. This is all vitally important, of course, because credit union operations have generally benefited from the economic expansion, and bottom line results overall are at cyclical highs. Yet fully 2/3 of respondents to CUNA's exam survey say that heavier regulatory and examination requirements are putting increasing pressure on credit union resources. And that makes efficiently serving members a more difficult challenge. I'd like to take the opportunity now to just briefly explore some of the themes that CUNA is hearing from member credit unions and through our committee process internally. We specifically engage members of our advocacy committee and our examination and supervision subcommittee on the issues in the budget, and my comments now reflect their views as well. On regional consolidation, first and foremost, we applaud the Ncua for its focus on cost savings and efficiency, as I said earlier, and consolidating the regions played a big role in that, and probably will into the future as well. We encourage the agency to focus on smooth transitions, however, in this process with as little disruption, philosophical disconnect, and course correction as possible. In particular, we urge the agency to be mindful of the results of CUNA's exam survey, which reflected great concern about the consolidation and especially the effect that having different sets of examiners coming into the shops would have on interactions with the supervisory team. Overall, 35% of the respondents to our survey indicated they believe new examination teams that might result from consolidation would have an extremely negative or a modestly negative impact on their examination experience. Inconsistency in the interpretation and application of rules and regulations are especially challenging, and we've talked about this many times in the past. We think it's more likely to be even more obvious in the context of regional consolidation. Those inconsistencies, of course, can throw credit union strategic plans off track, resulting in significant service disruption and misallocation of resources. In December 2018, the federal banking agencies issued a final rule to implement the provision in the Dodd-Frank the Economic Growth, Regulatory Relief, and Consumer Protection Act. What they did, of course, was they gave banks holding under $3 billion in assets the ability to have an examination once every 18 months. And of course, that leaves credit unions on an uneven playing field. Credit unions are eligible for an 18-month exam cycle only if their assets, as you know, are below $1 billion. This regulatory disparity now serves as a comparative advantage for community banks, we believe. Congress has already delegated authority to Ncua to set the frequency of examinations for credit unions. Credit unions deserve the privilege of providing customer service subject to comparable regulatory supervisory thresholds as applies to the banking organizations in this country. And this issue continues to be a concern amongst industry leadership. We urge the Ncua to extend the credit union asset threshold from $1 billion to $3 billion. In December of 2018, the board approved a reduction of the share insurance fund normal operating level from 1.39% to 1.38% for 2019. CUNA thanks Ncua for acting to lower the normal operating level, and we strongly support and encourage the agency to issue any additional share insurance fund distributions whenever possible and as soon as possible, with the exception that the initial increase, with the expectation that that initial increase to the normal operating level was temporary. We're encouraged that Ncua is honoring its commitment to review the normal operating level each year, and we look forward to the possibility of any additional distributions depending on Ncua's analysis. While the Ncua believes an increase in the normal operating level was necessary, while the insurance fund holds corporate legacy assets, we look forward to phase down of the NOL back to the 1.3% ratio that was the historical norm. In the interest of transparency, CUNA welcomes the Ncua's views on possible return of capital from conserved corporate credit unions, including more information and discussion on the mechanics and the considerations surrounding the decisions to sell or manage securities of the various estates after the guaranteed notes are retired. So more of a discussion on that, I think, is something that we're hearing from more and more members at this point. A couple notes on expanded Office of Consumer Financial Protection. Board Member Harper, as a supplement to the official budgetary process, has proposed the expansion of the agency's Office of Consumer Financial Protection with the goal of creating a dedicated consumer compliance examination program for large, complex credit unions. While this proposal may be well-intentioned, CUNA and our members believe altering the agency's risk-focused examination process and substantially increasing exam-related expenditures at this point is not warranted. There's been no supplementary evidence introduced or observed, at least that we can observe, to suggest that credit unions' consumer compliance management has become a risk area warranting an increase in expenditures of agency resources. Absent evidence demonstrating an emerging need or in establishing a clear benefit to all credit unions and to credit union members, we view the proposal as a solution in search of a problem. As its mission statement makes clear, the Ncua exists to ensure the safety and soundness of the credit union system, and its examination program should remain focused on that objective. In addition, the agency already has the tools in place to further evaluate a credit union's consumer compliance program when a need is identified through the risk-focused examination process. In fact, the current safety and soundness examination procedures include an evaluation of a credit union's consumer compliance risk, which is subsequently incorporated into a credit union's CAMEL rating. We also caution the Ncua against drawing parallels between itself and the bank regulators in terms of resource allocation or examination priorities. Ultimately, each federal banking agency is tasked to oversee significantly different entities with markedly different organizational structures, product offerings, and risk profiles. The fact that a regulator of for-profit banks identifies a systemic need for that industry to do something doesn't necessarily mean that other regulators, especially the regulator for not-for-profit cooperatives, ought to follow suit. Credit union's unique structure, embodied in member ownership and democratic control, ensures that the incentives faced by management are aligned with and are in the best interests of members. At credit unions, the absence of outside investors demanding a market rate of return on investment ensures pro-consumer behavior and strongly discourages abuses. Furthermore, CUNA's recent study of financial institution executive compensation reveals that, adjusted for asset size, bank chief executive officers receive a substantially higher portion of their overall compensation in the form of what we call high-powered compensation, or pay for performance. Those schemes, of course, encourage excessive risk-taking and a wide variety of anti-consumer behaviors. The Ncua, we believe, would be wise not to concede ground to the bank regulators as somehow doing it better. If that notion were true, then bank fines and lawsuits due to violations of consumer protection laws would not be as commonplace as they currently are. According to Barclays and Capital Performance Group, the largest domestic and European banks operating in the United States have incurred nearly $300 billion in fines since 2009. Rather than developing and implementing a new costly examination procedure, CUNA recommends the Ncua build upon the consumer compliance resources currently available to credit unions through the agency and further improve examiner training to ensure examinations are more efficient and less invasive. There are several other issues that we'll likely discuss in more detail in our written comments. However, in closing, I'd like to reiterate CUNA's belief that seeking and considering industry feedback prior to proposing regulations, adopting strategic initiatives, and producing detailed budgets really helps to ensure that those activities are better understood by all stakeholders. Ultimately, this means that they'll be more effective. The Ncua board, in its approach to the budget process, recognizes and clearly embraces that idea, and we encourage continued dialogue and focus on efficiencies and cost savings that allow credit unions to do what they do best, effectively serve and improve the financial health of millions of Americans. On behalf of CUNA, thank you for the opportunity to be here to speak to you today. I'd be happy to address any questions that you might have.
Great. Thank you, Mr. Shank. Ms. Ito, the floor is yours.
Good morning, Chairman Hood, Board Member McWaters, Board Member Harper, and also Rendell. Good morning.
Good morning.
Let me open by first acknowledging and thanking the board for its collective support of cooperation between the state system and Ncua. I do want to acknowledge Board Member McWaters for initiating, when you were chairman, the possibility for Ncua and NASCUS to take a look at the existing document of cooperation and pave the way for exploring it and seeing how we could improve it. Chairman Hood, thank you for, without skipping a beat, embracing the concepts behind the document of cooperation and then taking the time to confer with state regulators in San Francisco earlier this year and signing that document in a public event. Thank you. And Board Member Harper, we have heard you in your public statements supporting partnership with states, and we appreciate that. So thank you to all of you. The document of cooperation recommits not only Ncua, NASCUS, but also state regulators, all three of these groups, to a number of things. Certainly the mutual partnership that exists between the state and federal systems for supervision of federally insured state charters. It underscores that we have common goals in safety and soundness, but also fostering the vitality of the credit union system going forward. The document also underscores a culture of cooperation and mutual respect, and most importantly, open communications and constructive dialogue. We see opportunities such as today as Ncua is actually living what it says it's committed to. In the context of mutual cooperation, then I'm here today to speak on behalf of state regulatory agencies and also the broader credit union system. With all due respect to my fellow witnesses, we see a distinction at NASCUS. Maybe we're kind of sensitive to this, but as trade associations, we respect your work. At NASCUS, we don't see ourselves as a trade association. We see ourselves as a professional organization for regulators that happen to have credit unions in our membership. Now, today's briefing, although the briefing is about the budget, as I think all of you have heard NASCUS say before, representing state agencies, we actually find that it is state agencies, any agencies, federal as well, who we think are in the best position to determine what their resource needs are. So we won't be commenting on budget elements, but we do have a very focused interest on allocation of costs. So my remarks today will be about allocation, particularly in the context of the overhead transfer rate, OTR. I do thank Ncua for allowing us to comment on those aspects of the budget process. 2 years ago, and time flies, but 2 years ago, Ncua embarked on a bold and welcome departure from its past practice in determining the overhead transfer rate. We find the solution, the principles, very elegant and easy to understand. And as Rendell presented this morning, the principles of the overhead transfer rate that have been implemented, we find much easier than the previous methodology. There are three observations, though, that we wanted to highlight today. First of all, truly understanding what drives the OTR to go up and down. Secondly, consistency in the distribution of the OTR between federal and state credit unions. There I want to emphasize proportionality and just pose a couple questions. Lastly, we would like to explore revisiting the allocation of costs regarding Ncua supervision of QSOs and third parties. So starting with understanding what drives the OTR up and down, when we look at the first year in which the new methodology was implemented in 2018, that year the OTR went down by just over 5%. And that's understandable with the new methodology, particularly the 50-50 split for Ncua examiners between their federal chartering responsibilities and their insurance responsibilities. In 2019, the rate dropped again by about 1%, and we understand from the OTR summary explanation that that was due to a reduction in examiner time spent on state credit unions. This year, or I should say for 2020, the proposed budget shows a projected increase in the OTR by 0.08%. In scouring the staff justification, budget justification document, I realized that I couldn't figure out what it was. It seems like there are two possibilities: either that time with state credit union examinations is decreasing, or perhaps, is increasing, or that with federal credit unions it may be decreasing, or it could be a combination of the both that is leading to the expectation that that relatively speaking there will be more time spent on state exams. But I'm not able to actually understand specifically what's causing that increase this year and actually what's causing the decrease last year. I've speculated that perhaps for 2019, when the OTR went down, it makes us wonder, does it have anything to do with either the extended exam cycle or something else that may be going on in the broader system? For 2020, we wondered if it was merit. That's certainly going to be a huge effort. We also wonder perhaps it's the alternating exam pilot, although that doesn't seem like it's a huge amount. So again, we'd really like to understand. We realize that the OTR naturally will go up and down, but it would be fantastic if we were able to explain to ourselves and our stakeholders why it goes up or down. I did, in looking at that, realize a number of things. Certainly, I was thinking, I'm pretty sure Ncua has provided more detail on the OTR in the past. And digging through past documents, I realized that, yes, the OTR summary is provided separately from the budget justification. And I don't know timing-wise if that's a possibility for the agency, but I would recommend that in future that the OTR summary be provided as an appendix, perhaps, to the budget documents. You do have a lot of detail in there showing why how the OTR is calculated. So that's a suggestion. Secondly, we realize that we don't understand how Ncua collects federal examiner hours, and we're guessing that it must be self-reported by examiners, but we wonder about what validation there might be of any self-reported time, and also whether or not Ncua would look at what state hours are, not for purposes, that's not part of the new methodology, but simply to see whether or not state hours, independent of Ncua, whether or not they align with the hours that you've either recorded or projecting for the federal side. Thirdly, although this is not in my prepared remarks, something else that we are wondering about when Ncua puts the overhead transfer rate together, presumably it's a projection of what the costs are going to be in the coming budget year. It strikes us that we're not sure that projected expense versus actual cost is ever compared, and is there a need for us to look at that and look at adjustments? No idea, it may not be worth it, but just something that we pose for consideration. Secondly, moving to the OTR's consistency, the distribution of the OTR, its consistency with system proportionality. Let me first say that it strikes us that using insured shares seems like a very reasonable metric for determining how to split federal and state credit union responsibility for overhead transfer costs. And we look at the last few years, striking consistency over 2018 to 2020, where it's roughly 48.9%. It's federally insured state charters, 51.1% federal. But when we look at the number of credit unions in that time, and certainly it's also been consistent in terms of distribution, at the moment, our records and your records show that federal credit unions represent 63% of all federally insured credit unions, while state charters represent 37% of that group. Again, the insured share seems like an appropriate proxy. However, it strikes us that if you were to take a single $1 billion credit union, and then you were to take, say, two $500 million credit unions or three $333 million credit unions, those two exams together would probably take more time than the single $1 billion exam. And of course, with $333 million credit unions, that three exams are going to cost more than $1 billion exam. So again, we're just posing that question in future. That might be something to take a look at, since the overhead transfer rate is determined by time spent. Let me next move to my last point, and that has to do with the cost allocations of Ncua's costs of supervising CUSOs and third parties. As representing fellow regulators, we do understand the reasons for Ncua being concerned about its third-party authority. Even so, no matter what happens on that front, we would just like, right now, 100% of those costs for CUSOs and third parties, any costs of Ncua are 100% under the current methodology charged to the Share Insurance Fund. Our experience on the state side is that state regulators do spend time on that. So we're just saying that in future, with next year 2020, as we go into the 2021 budgeting season, it will be the 3-year mark for Ncua to open up the overhead transfer rate for review and public comment. So this might be an opportunity for us to take a look and see whether or not it still makes sense for 100% of those costs to go to the Share Insurance Fund. From where we sit, we're thinking a minimum of 25%, but welcome the chance to talk with you in future about that. In closing, again, thank you. We have described the new overhead transfer rate as an elegant alternative to the previous methodology. We do think that, as elegant as it is, there is potential for refinement, and that's the spirit in which we would like to engage in next year's review and discussion. Also, let me emphasize again, I know that at NASCAS, our obsession with cost allocations probably surprises some others, but again, we respect Ncua as a regulatory agency, that it knows what it needs. So looking forward to talking with you, and maybe I need some time with Rendell for me to understand what does make the OTR go up and down, and we do realize that it goes in both directions. Thank you.
Great. And thank you all this morning for your presentations and also for your written statements. I want you to know that regarding the written statements and some of the comments today, I am working with my team to look at some of the actionable items that you've suggested, and I'll be working with our staff here to see what can be implemented and what can't. But I just want you to know that you've given some great ideas today. I'm especially pleased that you all share my excitement and concern around cybersecurity. Excited because I think that the industry is marshaling its resources to really make sure that we are hardening our defenses. And yes, while we've appointed Johnny Davis here to assist with that, he's just one of many other individuals that will be really helping us provide you all with information to really have effective cyber hygiene. How do we not only harden our defenses, but how do we stay vigilant and aware? So I'm glad to know that you all recognize that that is an issue. Merit is something that I think, as you all here today talk about innovation, you talk about lengthening the examination cycle, you talk about efficiencies. The merit system, I think, once it is up and running, it is my hope that it will be able to do some of those things. Have any of you, quick question, have you at least seen merit yet or have heard about it. You've heard about it indefinitely. You've not. Well, I have seen it, and I think you will all be impressed when it is ready to be released. I think you're going to find that it really is going to in replacing that antiquated ARIES system, you're going to find it to be an elegant solution to examinations. It's going to be a wonderful way to really get real-time data, the reporting mechanisms, and I've seen it in action, and it's still being fine-tuned as we speak. The beautiful thing of it is that it will be iterative, meaning that as we want to add other components, the flexibility will be there. So I think you will be pleased with the investment that this industry is making, or this agency is making, in providing you all with that tool. I'm especially pleased that we are one of the first FIREA agencies to really come forward with a modernized not only examination system, but also with that the modernization of the call reports as well. So there is movement afoot. That, no questions, but I will see if any of my fellow board members have questions. Board Member Harper.
Thank you so much, Chairman, and thank you all for being here today and for helping to enlighten us and bring different viewpoints to the table. I am a firm believer that the more viewpoints you hear, the better policy that you ultimately be able to come to, and in this case, the better budget that you may ultimately be able to come for. I also want to echo the Chairman's focus on cybersecurity. It's a priority for both of us, very much so. And on the merit system, not only is it going to be a new system that is forward-looking, it's going to be a best-in-class solution. From what I have heard from state regulators who I've spoken to, particularly those state regulators who operate on both the credit union and bank side, so they have the awareness of this issue. They are especially liking the analytics that have been developed in the system and feel that it's even better than the set of analytics that the bank systems currently allow for. So I think that that is a good step forward. I do have a couple of questions, Mr. Chairman, if you don't mind. First of all, Lucy, I do hear you very loud and clearly on increased transparency for the OTR and the desire for a summary for the OTR calculation to be accompanied with the budget docs. That's something that I need to talk to Rendell and to others in the E&I team about the possibility of doing that. But to the extent that we can, we should try to do that, or at least to follow up in close proximity as we can. Sometimes streams operate in different levels, exactly, and you can't get there. Second, Lucy, you've been very helpful to me in helping to understand what states are doing with respect to consumer financial protection. And as I understand it, there are some states that do a separate consumer compliance rating that they assign, and that in fact, we are building the new merit system to allow those states that do have a separate consumer compliance rating system to enter and maintain that information. Am I correct in that assessment?
That is true, that some states do have a separate consumer compliance rating.
And a separate rating is important for you, particularly as you grow in size, so that you make sure that you have the opportunity to look at consumer compliance issues, because sometimes as you grow in size, you gain complexity, and you may lose focus. I appreciate Mike's comments, and I'll get there in a second, about the need to look at this issue comprehensively and holistically. But I do believe that a focus on a separate consumer compliance rating outside of the CAMEL rating can help pay attention to what are the issues that need to be addressed overall. Finally, Lucy, we had a great exchange last week with a number of your members and state regulators, and we talked about a number of issues, including consumer financial protection. When I was in that room and we were talking at the table, I heard for those credit unions that were getting close to the $10 billion threshold at which CFPB supervision begins for consumer compliance issues, and those that had crossed the threshold. So both on both sides, both not quite there yet, but had crossed, that they thought that we could do a better job in helping them to get ready for CFPB supervision. Did I hear that correctly in the room?
Yes, credit unions did say that they would welcome that, and we'd be happy to work with the agency in looking at how that might be accomplished.
Thank you so much, Lucy. And Kurt, I appreciated your comments today. You certainly gave us a lot to think about overall, particularly with respect to overall doing cost-benefit analysis on how we do things. One thing I did want to point out is that at one point in time, the agency did do an examination survey post, and we found that we weren't getting much information. There wasn't a high reply rate, and that we were spending more resources. And we did do a cost-benefit analysis and made the decision in order to drop that. That doesn't mean we shouldn't look at the issue again and look at the issue anew, and I appreciate that. But I just wanted to provide that background. One other thing I did want to ask is, as you know, I called for the creation of a dedicated consumer compliance program. Overall, your written statement didn't pay much detail on that, or at least I didn't see anything in it. Will NAFQ be providing some comments to me as part of the budget submission, which is due by December 2nd?
We will be weighing in on that proposals.
Terrific. Thank you so much. And then finally, Mike, I do appreciate your comments. I think we are viewing the world in two slightly different lenses. One, you had talked about significant increase in the agency's resources. I think that that is applying something that we do not know yet, whether it will be a significant increase or not. I have begun a discussion, and my proposal is to bring on 3 people to help us scope out what a program can and should look like, particularly for large, complex credit unions, and having a dedicated consumer compliance program. So I think it's too early to say whether it will be significant or not. I also think that there are a number of issues that would weigh in on overall on the credit union system. One of those is reputational risk. I certainly appreciate that credit unions are not for profit. There are certainly some institutions in the bank side of the world, particularly mutual thrifts, that are not for profit. So I don't think that you can just apply that and say that in one way for the credit union system and not recognize that there are differences in the bank system as well that do have some things they're related. You did talk about building consumer compliance resources that are available to credit Ncua, and that may be a different way of getting at my issue, making sure that credit unions remain focused on their consumer compliance responsibilities. I was wondering, you talked about it very generally. Could you provide some more specifics about what those consumer compliance resources might look like?
You know, I don't have a concrete list in my mind at the moment, and most of what I said was a direct reflection of our short conversation with the folks on our advocacy committee and our exam committee.
Sure.
So we can certainly circle back with them and provide you with some examples.
That would be great. And Mike, I would very much be appreciative. I'm happy to have meetings, and also Kurt with you. I'm hoping that both CUNA and NAFQ will have time in the coming next few weeks before we actually consider the budget to come in so that we can talk a little bit more about consumer financial protection and what might be done there. And then finally, just one last question, Mike. You wrote in your statement that Ncua has set the standard for what might reasonably be viewed as a budget process best practices in terms of what we're doing in transparency. And I very much agree with that. Could you elaborate a little bit more why you think we are best in class and have best practices on budget transparency?
Well, just as I said, I've had a long experience in looking at the budget and the budget process, and up until very recently, most of the material that I needed to come to any conclusion on what was going on and how it related to the strategic plan, it was very difficult to come by. And now, when I first started doing this in a very detailed way, I did go to the banking agency's websites, and I found exactly what Rendell had described. It just doesn't exist, and the material that is there is at such a high level that you can't really draw too many reasonable conclusions. So also, as Rendell mentioned, the budget hearing that you hold is something that's unprecedented when we look across the spectrum. So we, as you know, advocated for that, and you responded, and we really appreciate it.
Thank you.
Great, thank you. Board Member McWaters.
Thank you very much, Mr. Chair. The first 2 budgets I participated in at the Ncua, I dissented for these very reasons. There was not a budget hearing. There was not an opportunity to hear directly, face to face, across the table from leaders in the credit union community about how we're basically spending the money of credit unions. And so this is very important. Also, the transparency issue. I had the same problem you did. I looked at the budget with, an accounting background, finance background. I couldn't understand. I just didn't understand what was going on there. And so, again, I commend Rendell and what he's done, his team has done to make the budget very transparent. Does that mean it's perfect? Does that mean there's no room for improvement? I don't think so. There's always room for improvement, and I'm sure next year Rendell's budget will be more so in ways that he will determine, and I respect that. Other than that, today for me is a day to listen to you guys and to read your materials again while you're speaking to me, and to let those roll over me so we can reflect on them over the next month or so. So I very much appreciate you coming, drafting your submission, and talking to us today. That's what this is all about, communication. Thank you.
Great. And again, thank you all. Ladies and gentlemen, this does in fact conclude our agenda today. A sincere thank you again to the staff that helped draft this proposal and to the stakeholders for presenting their views. As a final reminder, the public is invited to email their written comments on the 2020-2021 budget to budgetcomments@ncua.gov. Again, that's budgetcomments@ncua.gov until December 2nd. We plan to take up the final budget at the December board meeting on December 12th, 2019. So for those of you who will be here tomorrow in town, I look forward to seeing you for our board meeting in this very room tomorrow. There being no further business, this meeting is hereby adjourned.